In finance, the most powerful expense is often the quietest. Depreciation is the silent force that can save your business crores, if you know how to use it. Too many see it as a technicality, buried in reports, but in reality, it's a strategic tool that shapes your company's cash flow, tax bill, and even its valuation. Let's uncover why depreciation is far more than just an accounting entry. Depreciation means spreading the cost of an asset, like a machine or a vehicle. Over the years, it actually helps your business. Instead of taking a huge hit in year one, you allocate the expense across its useful life. This gives a true, fair view of your profits and prevents sudden shocks to your financial statements. Think of it this way: a machine that generates revenue for 10 years should have its cost matched to the value it creates each year. This is the matching principle in action, one of the foundations of smart accounting. It ensures your financials reflect reality, not just paperwork. Here's the real power. Depreciation is a non-cash expense. No money leaves your bank account, but your taxable income drops. This legal tax shield means you pay less tax, keeping more cash in your business, fuel for growth, innovation, and opportunity. Mastering depreciation isn't just about compliance, it's about unlocking hidden value. Used strategically, it can transform your bottom line, boost your valuation, and give you a competitive edge. In this series, we'll break down every lever and method so you can turn this silent expense into a powerful advantage. When it comes to depreciation, managers have 5 powerful levers at their disposal. Each one can dramatically impact your company's tax bill and cash flow. Let's break down these strategic levers one by one and see how you can use them to your advantage. Think of this as your playbook for turning accounting rules into real-world financial wins. Lever 1. Maximize your depreciable base. This means including not just the invoice price of an asset, but every allowable cost: freight, installation, site preparation, and even legal fees. For example, if you buy a machine for 50 lakhs, pay 5 lakhs for transport, 2 lakhs for site prep, and 3 lakhs for installation, your depreciable base is 60 lakhs, not 50. That's a 20% increase in tax-deductible expense, and it adds up to real savings over time. Smart managers never leave money on the table. Lever 2. Control the timeline. The useful life you assign to an asset determines how quickly you can claim depreciation. A shorter useful life means higher annual depreciation and bigger tax shields up front. For instance, if you can justify a 5-year life instead of 10, your yearly deduction doubles. This is especially valuable for fast-moving industries or when you need to boost cash flow now. The key is to balance aggressive tax savings with realistic asset usage. Lever 3. Justify accelerated wear and tear. If your machines run 3 shifts a day instead of 1, you have a strong case for a shorter useful life. Documenting intensive use, like 24/7 operations or harsh environments, lets you accelerate depreciation legally. Keep detailed logs and maintenance records as evidence. This lever is about matching your accounting to operational reality, and it can unlock significant tax savings. Lever 4. Account for technological obsolescence. In today's world, technology can become outdated long before it physically wears out. For example, a computer might last 7 years, but in a software company, it could be obsolete in 3. By recognizing this, you can justify a shorter depreciation period and claim higher deductions sooner. Stay ahead by aligning your depreciation schedule with your upgrade cycle. Lever 5. Minimize salvage value. Total depreciation equals cost minus salvage value. The lower your estimated salvage value at the end of an asset's life, the more you can depreciate. For assets likely to be scrapped or obsolete, justify a nil or minimal salvage value. This increases your annual deductions and maximizes your tax shield. Always document your rationale for auditors. Mastering these 5 levers transforms depreciation from a routine accounting entry into a strategic tool for wealth creation. By maximizing your depreciable base, controlling the timeline, documenting intensive use, accounting for obsolescence, and minimizing salvage value, you can unlock substantial tax savings and boost your company's cash flow. The best managers use these levers not just to comply with the law, but to drive growth and outpace the competition. Depreciation is more than just an accounting entry. It's a strategic tool that serves several objectives. First, it applies the matching principle. ensuring that the cost of an asset is allocated to the periods in which it generates revenue. Second, it provides a fair and true view of a company's financial position by reflecting the gradual consumption of assets. Third, it helps businesses plan for asset replacement by recognizing the wear and tear over time. Fourth, it ensures compliance with accounting standards and tax laws. Finally, accurate depreciation leads to precise product costing, which is essential for pricing and profitability analysis. Let's dive into the two most widely used depreciation methods, the straight-line method, or SLM, and the written-down value method, or WDV. The straight-line method spreads the depreciable amount of an asset evenly over its useful life. The formula is simple. Depreciation per year equals cost minus salvage value, divided by useful life. For example, if a machine costs 10 lakhs, has a salvage value of 1 lakh, and a useful life of 9 years, annual depreciation is 1 lakh. The SLM method results in predictable and stable profits, making it ideal for companies that want to show consistent earnings to investors and lenders. It also simplifies budgeting for asset replacement, since the depreciation expense is the same every year. The written-down value method, or WDV, accelerates depreciation by applying a fixed percentage to the asset's reducing balance each year. The formula is depreciation for the year equals opening book, value times rate of depreciation. For example, if a machine costs 10 lakhs and the rate is 20%, first-year depreciation is 2 lakhs. In the second year, depreciation is 20% of 8 lakhs, or 1.6 lakhs, and so on. WDV front-loads depreciation, resulting in higher expenses and lower profits in the early years, but significant tax savings up front. This method is favored by companies seeking to maximize cash flow for reinvestment or debt reduction, especially when assets lose value quickly. Advanced strategies can further enhance depreciation benefits. Consider the time value of money. Claiming higher depreciation earlier increases present value of tax savings. Timing asset purchases near year-end can yield a full year's depreciation for minimal use. Component accounting allows you to depreciate parts of an asset separately, reflecting their actual wear and tear. Regularly re-evaluating useful life ensures your depreciation matches operational reality. It's also important to distinguish between a reserve and a provision. A provision is a charge against profits for a known liability or loss, such as depreciation. A reserve, on the other hand, is an appropriation of profits set aside for future needs or contingencies. Depreciation is always a provision, not a reserve. Now let's walk through a real-world case study. Kanpur Leather Tannery. The company invested 1.2 crores in Italian processing equipment. The invoice price was 1 crore, but after adding freight, import duties, and installation, the total cost reached 1.2 crores. This is the first strategic move, maximizing the depreciable base. Next, let's apply the straight-line method. Depreciation per year equals 1.2 crores minus 0 salvage, divided by 10 years, so 12 lakhs per year. The annual tax saving, assuming a 30% tax rate, is 3.6 lakhs. Over 10 years, total tax saved is 36 lakhs. Now, let's see the impact of the written-down value method. Assume a 25% depreciation rate. First-year depreciation is 30 lakhs, saving 9 lakhs in tax immediately. Second-year depreciation is 22.5 lakhs, saving 6.75 lakhs, and so on. The company gets larger tax shields in the early years, boosting cash flow for reinvestment. The tannery's management made a key decision. They documented that the equipment runs 3 shifts, 24/7. This justified reducing the useful life from 10 years to 5 years. With SLM, annual depreciation becomes 24 lakhs, and with WDV, first-year depreciation jumps to 60 lakhs. The tax savings are massive, and the company can reinvest this cash or pay down debt. By combining these strategies, maximizing depreciable base, choosing the right method, and documenting intensive use, the tannery slashed its tax bill to nearly 0 in the first year. This is the power of strategic depreciation, turning a routine accounting entry into a driver of growth, innovation, and long-term value. As we wrap up, remember, depreciation isn't just a technical accounting entry, it's a powerful strategic tool. When used wisely, it can unlock cash flow, fuel growth, and strengthen your company's financial health. Each lever, maximizing your depreciable base, controlling asset life, documenting intensive use, factoring in obsolescence, and minimizing salvage value, gives you a way to shape your financial outcomes. The method you choose, straight line or written down value, directly impacts your cash flow and reported profits. Make these choices intentionally, based on your business goals. And don't forget, reserves are funds set aside for future losses, while provisions are for known liabilities. Understanding this distinction is crucial for accurate financial reporting. Here are your action steps. First, always include all eligible costs in your depreciable base. Second, keep detailed usage and maintenance records. Third, review asset lives regularly and adjust for technological changes. Fourth, justify low salvage values when appropriate. And finally, select your depreciation method to align with your strategic objectives. Master these principles, and you'll turn depreciation from a compliance task into a source of competitive advantage. Whether you're a manager or a student, applying these strategies can help you drive real value, transforming accounting entries into opportunities for growth, resilience, and long-term success.